Hey guys, welcome to Lumovest. If you've been following this channel, chances are you've seen our previous video titled Did the Stock Market Bottom?, where we compared the stock price movements of S&P 500 during the 2001 and 2008 recessions with what we are seeing now in 2020. We've received a lot of feedback from you guys, asking us to present a more balanced view. So we've decided to create a two-part series, looking at the bull case for why the market has already bottomed and why it'll soar from here onwards, as well as the bear case for why the market has yet to bottom and why there could be an even larger crash waiting to happen. This video is part one of the two-part series, where we're going to dig into the bull case and understand the bullish investor's argument for why the market won't retest March 23rd lows. Alright, without further ado, let's jump in. So why do the bulls think S&P 500 already bottomed? Why do they think S&P 500 will go up from here on out? The first reason is that many companies that make up the S&P 500 actually stand to benefit from the coronavirus crisis. The S&P 500 is a collection of the 500 largest companies traded on the United States stock market, weighted by each company's market cap. So a company like Microsoft makes up 5.9% of the S&P 500 index just by itself, while a company like United Airlines only holds 0.06% of the index. The coronavirus crisis doesn't have the equal impact on every business. A small subset of the 500 companies are actually better off in 2020 than they were in 2019. They're benefiting from the coronavirus crisis and will actually make more money because of it, at least in the short term. Sure, we see the economy getting locked down. A lot of people losing their jobs and struggling to support their families. We read in the news how airlines, hotels, and retailers are about to fail and they need to be saved by the government. Most of these 500 companies in the S&P index are getting hit hard, but there is a small group of companies that are either unaffected or positively affected by the coronavirus crisis. These companies fall into three sectors: technology, consumer, and healthcare. Coincidentally, the companies that stand to benefit the most from the coronavirus crisis are actually America's largest companies. They make up a disproportionate percentage of the S&P 500. Just these 25 companies by themselves make up 30% of the S&P 500 index. The remaining 70% of the index, on the other hand, is split by the other 475 companies. Take Amazon, for example. 4% of the S&P 500 index is made up by Amazon. And Amazon's stock price is up almost 30% year-to-date in 2020 because everyone is buying from Amazon since people can't go out. Same thing with PayPal. People are staying home, so they're using PayPal to buy things online. PayPal stock is up 35% year-to-date in 2020. These companies are making more money thanks to coronavirus. Companies like airlines, cruise lines, restaurants, hotels, retailers, movie theaters are near collapse because of the coronavirus, but these companies make up only a small proportion of the S&P 500. Companies that hold a disproportionately large weighting of the S&P 500 index, like Microsoft, Amazon, Netflix, Clorox, they're generating higher revenue and their stock prices are actually going up. And by the way, these are just the largest companies. There are a few other names, like Zoom and Shopify, that benefited tremendously from coronavirus. This creates a highly bifurcated situation, where on the one end, a small group of companies making up 30% of the index is either resilient to or benefiting from the crisis, while on the other end, companies representing 70% of the S&P 500 index are suffering from the fallout. So what's the implication of this? The implication is that stock price increases in the first group is softening the stock price decreases in the second group. Let's do the math. The S&P 500 reached the March bottom after declining 34% from the February 19th peak. So in order to reach a new bottom, the index has to decline to at least 35% from the peak. If the companies in the first group go up by just 10% from the February 19th peak, which many of them are, then in order for the overall S&P 500 index to fall by 35%, that means the companies in the second group with the 70% weighting will need to fall by a staggering 55%. That's what would be required mathematically to bring the overall S&P 500 down to 35%. If the companies in the first group stay flat, then in order for the overall market to fall by 35%, the companies in the second group will need to fall by 50%. If the companies in the first group falls by 10%, then the companies in the second group will need to fall by 45%. That's pure math. So as you can see, because there's these companies compromising 30% of the S&P 500, softening the blow, the rest of the companies will need to be cut by half in order for the market to reach a new bottom. Now that lockdowns are being lifted, it's becoming increasingly unlikely that the current stockholders will be willing to sell their shares at half the price. So mathematically, it's very difficult for the bullish investors to see the path to get to a new low. That's one way of looking at whether the market will reach a new bottom by looking at the individual component making up the market. By the way, if you want to learn more about finance and investing, definitely check out our website. We have a structured curriculum on our site where you can learn about investing in greater detail. The second major reason why many people believe the market has already bottomed is that uncertainties are being removed and the way forward for the economy is becoming increasingly clear. Back in February, things were looking very scary. The United States was entering lockdown, businesses were forced to close, and there were a lot of uncertainties. Investors didn't know how long the lockdown will last. They didn't know what actions the Congress and the Fed will take. They didn't know if there's enough money for all the businesses that need to borrow loans. They didn't know how much worse Russia and Saudi Arabia's feud will disrupt the world's oil supply. They didn't know how China is recovering. And so there were a lot of uncertainties back in February. These uncertainties create fear, and this fear of uncertainties motivate investors to frantically sell out their holdings. Because there was so much selling pressure, that pushed down the stock price. But over the last 2 months, many of these uncertainties have been removed, and the market is now getting an increasingly clear picture of the path forward. States are reopening. Europe has flattened the curve and is also reopening. Congress passed fiscal stimulus plans. Federal Reserve cut interest rates and injected money. Many of the S&P 500 companies secured their needed financing. Small businesses got cheap loans. Russia and Saudi Arabia called truce to their oil price war. China is recovering. Vaccines and drugs are being developed. And so now, all of a sudden, things have changed. The market can see the path forward to get out of the ditch. What caused the massive panic selling in February and March was the fear of uncertainties. And the bull's argument here is that yes, the economy is really bad right now. But bit by bit, the company is starting to get back to normal. Once the virus is controlled, the stimulus effects of fiscal and monetary policies will kick in. From there, we'll work towards recovery. It might take a while, but the market now knows that the worst is behind us. Many uncertainties about the crisis have played out, and now we have increasing clarity about what needs to be done and get the economy back in shape. And so without additional events that create further uncertainties about the future, there may not be enough selling pressure to push the market down to a new bottom. These events that trigger buying or selling are called catalysts. Catalysts are events that happen that causes the stock price to move towards your target price. Anytime you invest in a stock based on the thesis that it deserves a higher price or a lower price from where you bought it, you should try to identify the catalyst that will make the market realize that it deserves that price instead. During the 2008 financial crisis, the stock market tanked over time as banks collapsed one after another. Bear Stearns, Lehman Brothers, Wachovia, Merrill Lynch. These collapses catalyzed market sell-offs over the course of the year. And back in February 2020, the catalyst for the massive sell-off is the realization that the virus is being spread across Europe and the United States. Likewise, there needs to be a catalyst to trigger another wave of sell-off for the stock market to reach a new bottom. What would that catalyst be? One catalyst could be a reignited confrontation with China. Another catalyst could be a second shutdown. Or it could be the eventual realization that the economy is in fact in terrible shape and there's no V-shaped recovery. The bulls believe, now that uncertainties are removed, there are fewer catalysts that can cause this, and so there might not be another sell-off. And finally, the third reason why the bullish investors believe the stock market has already bottomed is that the stock market is looking towards the future. Yes, things are really bad right now. More than 1 million Americans infected. Over 33 million people filed for unemployment insurance, and unemployment rate reached about 15% in April. Big corporations are reporting a decline in earnings. GDP contracted in the first quarter and will fall even more in the second quarter. So it's clear to everyone that the economy is significantly damaged. And a lot of people say that the stock market doesn't deserve to go up when the economy is going down. But guess what? There's no law of physics that says if the economy is in shambles, the stock market must fall. They tend to go hand in hand in the past, but there's no natural law requiring stock market to fall just because the economy isn't doing well. Kind of like hard work and success. Hard work tends to lead to success, but there's no law saying if you work hard, you'll succeed. Likewise, the universe doesn't have a rule that mandates stock market to fall just because economic data are poor. Yes, these data are really gloomy now, but the stock market is looking past that. Once the economy reopens and the world develops a vaccine or a drug, things will start to get back to normal again. All these unemployment data about how millions of people are now unemployed, they're just telling us what has happened in the past and what's happening now. But we don't care about what happened in the past, we care about the future. And it's looking increasingly clear that things will go back to normal in the future. It's not like unemployment rate will stay at 15% forever. If it will, people probably wouldn't be waiting for a new bottom to invest because the stock market could be staying at that bottom forever. Instead, the stock market is forward-looking. It has already accepted the fact that the economy will contract in 2020. As each day passes, new progress is being made at containing the virus, and it's looking increasingly certain that the economy will recover in 2021. People have faith in the long-term outlook of America and believe that the American magic will overcome tough problems. So the thinking is that yes, things may be bad this year, but it has already happened, and things will start to recover in 2021, and the long-term intrinsic value of these companies remain intact. Knowing that business may be bad this year, but things will return to normal next year, if you own a piece of the companies in S&P 500, would you be willing to sell it at a 35% discount? If you wouldn't be willing to sell it at 35% discount to other people, why should the current shareholders sell it to you at 35% discount? Therefore, because the market is forward-looking, it has already accepted that 2020 will be back and looked beyond it to take into consideration the long-term prospect of the American economy, which remains strong and prosperous. Thanks for watching this video, guys. If you like this video, please share it with at least one friend. It'll help us to get more views and grow faster, which allows us to make more and even better videos for you. Thanks so much, and see you guys next time.